It's been a tremendous rally, as you said. Last year there were the geopolitical risks weighing, there was a slight weakness in growth weighing, and yet equities continue to push higher and higher. And certainly even at the beginning of this year, even after the geopolitical shock with the US and Iran, and still we're looking at new record highs. Would I expect that to continue at this pace? Probably not. We've already got a lot of good news built in. So the barriers, kind of the wall that equities need to climb is that much higher. But having said that, given that we expect central banks around the world to maintain this very, very ample liquidity that they have and that they're providing, we would think that there's continued support for equities. We think that growth will stabilize and have a slight upturn. So again, that's another support. But certainly we don't expect the kind of returns that we saw in 2019.
You mentioned the central bank, Seema. That's been a real big theme among many of the guests that we've had on our air throughout the course of the last several months now. Is this a situation, a scenario where they can keep on pumping enough liquidity to keep those markets higher? We've also heard a lot of chatter that central banks need fiscal help as well to keep these economies and markets going.
Yeah, I think that what we should expect to see this year is you have a kind of a status quo. So central banks continue pumping in that liquidity. We don't have many fears about the balance sheets. Can they continue to increase? They can, at least through the rest of this year. But having said that, they do now need to turn to fiscal policy, because as we look to 2021, we have got some concerns growing about the economy. And by next year, we need a lot of that fiscal stimulus, at least in Europe, to come through, and potentially in the US as well.
Where exactly is going to be the biggest hotspot out there as we talk about the notion that these markets sit near record highs, globally speaking, for some of the major developed ones? Is there a notion that the U.S. is still the best place to be?
We do expect positive returns in the US, but we think you can get better outside. So actually, we like Europe, and we especially like emerging markets. Now, having said that, given the rally that you've had over the last month and a half, a lot of those targets are almost close to being met. So we are going to be running out of steam relatively soon. But at this stage, we like emerging market Asia. And the reason for that is, a lot of those central banks still do have room to cut rates further. You can expect fiscal stimulus from a number of those countries, and especially with the Fed on hold and at least some move for a potentially slightly weaker dollar, that will also help emerging markets.
Which of those emerging markets, though, seems to be the one that stands out the most? Are we going to still look towards East Asia for those? Are we going to look towards places perhaps like South Asia or even the Europe, Middle East, and Africa for certain of those markets?
Yeah, so actually East Asia, and actually one of the runs that we really like is China. So we like China consumer discretionary. We see a lot of flows in, and actually it's probably one of our top picks for this year.
All right, so China's in focus there. Let's bring it back towards the U.S. shores as well. We know that the geopolitical risks have eased a little bit. We have a big jobs number coming out later on today, Seema. Is the U.S. economy here on track to sustain these moves, and can it keep kind of powering the global economy and markets as well?
So we think that the U.S. economy is stabilizing. Some of the data has been disappointing in the last few weeks, but we do think it's going to have a slight upturn coming through. Now, in terms of is it enough to power through? Probably not. But because we expect a global synchronized expansion, together they're all doing the hard work to support everything. But with the labor market specifically, we have seen signs of softening coming through since last year. We're expecting that to follow through 2019. So, there are pockets of weakness starting to come through, but that's not enough to stop an expansion for the global economy, and especially for the US in 2020.